I honestly believe at this point, it's a matter of understanding where to put your money because money has to work for you. So it's either you work for money, or money works for you. So unfortunately, most people work for money, so they never get to keep it. So the idea here is I'm going to talk today about how you can make money literally work for you rather than the other way around. Because I have one simple goal. Everybody, in my opinion, needs to learn something we call investing. Everybody got to know how to invest. The moment you learn how to invest, you are going to be just good to go. I'm going to cover with you guys 10 different places where you can put your money, potentially make 6, 7, 8, 9, even 10%. This is not one of those YouTube where you just watch casual or you watch it like a movie. No, this is a YouTube you watch with a pen and a paper and you write. Because if you're looking to make money work for you, this is your spot. This is where you want to be. You want to take a lot of notes. If you're looking to say, maybe I got 1,000 to 10,000 to 100,000 to a million or whatever the case might be, this right here is for you because I'm going to show you how you can use the power of compound interest, to double, triple your money over a long period of time or even more. But again, financial literacy and education is extremely important because that's how this is going to work for you. So let me get into it, okay? So the first one I'm going to cover with you guys is called the growth stocks. What does that really mean? Okay, growth stocks. Growth stocks simply means this, okay? That stocks of companies that are expected to grow at a faster rate than the overall market, we call them growth stocks. Like, for example, okay, growth stocks that have historically provided a very substantial return, often well above 10%. Again, that's why we call them growth stocks, especially in sectors like technology and healthcare. So, that those two areas right there, technology and healthcare, has proven to work quite efficiently. The second one, and I know quite a number of people are not familiar with this, but it's a good one to take a look at. It's a real estate investment trust. We call it REITs. REITs has been around for quite a while. By the way, before I go into REITs in full detail, let me give you an example, okay? An example of a growth stock. Amazon is considered a growth stock. Apple is considered a growth stock. Tesla is considered a growth stock. The risk, they have higher volatility and risk of losses during market downturn. So it's up and it's a down. So it's a sharp up or a sharp down. So you have to have a reasonable level of risk tolerance if you're going to use this, as a primary, a source of investing for you. So you have to be, again, your risk tolerance level has to be enduring, has to be big enough. Second one is your REITs, okay? Real estate investment trust. Overview, meaning companies that own, operate or even finance income producing real estate. REITs often provide dividends, and a lot of people they like dividends a lot. So with REITs, the potential for capital appreciation with average historical returns above 10% is very real. So again, real estate investment trust is a very good source for you. You see, example of REITs, it's a public storage or American Tower. Again, it's an example of REITs. As the risk, market and sector risk, they're influenced by interest rates and property market trends. So if you're going to use REITs, just be aware of both the potential up and down. The third one I want to cover with you guys, again, this is putting money away with a higher return on your money. Allow compounding interest to work to your favor. This is the way the wealthy people falls. A poor person works trading time for money. A wealthy person works trading their knowledge and ability for investing for a higher return. It's just the way the world works. So this may be boring to quite a number of people, but boring is where your money is made. So number 3 is called peer-to-peer lending or P2P lending. Okay, peer-to-peer. You see, platforms like this allow investors to be able to lend money directly to individuals or even businesses in exchange for interest payments. So in this case, okay, don't worry, you know what? I'm going to lend you 50 G's, or I'm going to lend you $100,000. You're going to pay me an interest of say 4%, 5%, or even 6%. So I make a 5 grand or 6 grand on my $100,000, no problem. Okay. You say platforms like a lending club, they have prospered historically because they offer returns of 6 to 10%, or more, depending on the borrower's risk. So you have a big chunk of money that could return back to you simply because of what? Because you have the money to lend. Now, the risk there is you have a very high risk of defaults. You don't pay the loan back, especially in economic downturns when things are tough in the economy. People get really different, and people act a little funny when the economy is down. So, what I would say in so many ways and in so many returns, is this: that if you happen to be using the investment strategy called peer-to-peer lending, just understand that you also are dealing with the potential risk of not being able to collect potentially your money back. The more you know, the better. Okay, let me go to number 4. I am not a big fan of cryptocurrency. I gotta be the first one to tell you. I'm just not, for very obvious reasons. Because for me, I have very little problem with the centralized monetary system. I don't have a problem with that. But for me, I can't just take a look at an item and give this item a massive value and then expect the world to cave to it and everybody's going crazy. Oh, this item is 1 million. What the heck? But this item is not producing me anything, but I'm attaching $1 million to it. Wow. Why? Who attached the valuations? Why? Because you're a celebrity? See, I got a problem with that. I do. I have a problem with that. So I like something that produces something that I can gauge, I can measure, I can quantify. So that's the only issue I have. In that sense, okay, cryptocurrency is digital. As you guys can tell, virtual currencies that use cryptography for security, and there's quite a number of quite a number of currencies that do this. Okay, so they use crypto, and especially what I just mentioned to you guys right now, cryptography for security. So with like Bitcoin, okay? Bitcoin, obviously, most people in that space, they use Bitcoin or Ethereum, being the most prominent one that they use. Now, cryptocurrencies have shown extreme volatility lately. As you guys can see, it can offer very high return, 10%, even more. But then when it crashed, God have mercy. Guys, I tell people, do not go into the world of cryptocurrency unless you know that you are ready to put up with the effect of the downturn. So the example of cryptocurrencies include Bitcoin, Ethereum, Solana. Yes, and the risk very, very, very high, very volatile. And not only that too, there is regulatory risk. So because the government could just wake up one day and say, I don't want that anymore, then what happened? Bam, there goes your cash. So be prepared to understand there are pluses and minuses to this. Number 5. Number 5 is one most people don't talk about, but it's a very big one. Guys, I'm a big fan of using what we call an index universal life insurance policies, also known as equity indexing universal life, because it is the type of a life insurance policy that you can use for a savings plan, almost similar to investments. But some of these companies are doing 7%, 8%, 9%, at the high end 10%. But what it will do is this, and this is the crazy part of this. Some of those policies, like when you are, when the market is good, you make a lot of money. They may not give you the full entire credit. Say the market is doing 20%, they might give you more like a 12%. But in return, if the market comes crashing, you don't lose anything. So that is a very fundamentally sound type of a product that you can use for insurance, and you can also use for investment. So the only disclosure is this: you have to have a reasonable level of good health. That's the only disclosure. Because if your health is not good enough you potentially could have a problem with that. The next one I want to share with you guys is called private equity. Number 6. You see, investment in private companies, in buyouts or buyouts, I'm sorry, of public companies, are real. Let me explain exactly what I mean, okay, by that, okay? You see, by the way, Australia, you're in the house. It's very nice to see you, my friend. Hope you're doing phenomenal, okay? Hope you're doing good. Give me a like, but how do I say your name? Abishtank, if I get it right. But nice to see you here, my friend. So, private equity, has historically provided double-digit returns. They have, but the investment is illiquid as a long-term horizon. So, if you're one of those that you are concerned, and you can't wait for a long time on your investment, private equity may not be the place you want to be, because a lot of them are a little more, okay, a little more on a long term basis. If you understand what I mean. So, having said that, right? Why do people do private equity? Why though? The investment has a high potential of giving you 10% or more. And so because of that, it's appealing to a lot of people. Example of that is a Blackstone. That's a good example. The risk is that they are very highly illiquid, just like real estate, and market factors affecting company valuations could also impact the value again of your investments. So then you have something we call venture capital. You hear somebody say about what is a venture capitalist. By the way, if you ever hear the expression venture capitalist, you're talking about somebody that's dealing with money, real money. So you're never going to find someone that is a venture capitalist, that is heavily struggling. So these guys, girls and guys, they have money to work with. They do. Now watch this, and I think it's going to make a lot of sense to you. Funding early stage like startups companies. So a lot of startups, they actually use venture capital, because it has a very high growth potential. You see, venture capital can offer high returns if a company grows like very rapidly, and the company could be acquired, often exceeding 10% return. So a venture capital, it's a very good way for you to make a lot of money, apparently. See, what are the example of those? If you look at early investments in companies like Uber or Airbnb, that's a perfect example. So what you are supposed to do is find a company, know that is coming out, and then automatically put yourself in a position to invest in that company at the early phase so you can become a venture capitalist. You see, the risk though, the company could fail because a lot of startup can fail. So that requires a lot of diversification. So you have to diversify your investment so you're not like in one place. Otherwise, obviously, what will happen to you. Let's go to number 8. It's ETFs. ETFs is probably one of my best. Let me explain what I mean. I love ETFs. You see, ETF stands for Exchange Traded Funds. That's called ETF. Exchange Traded Funds. That's called ETFs. You see, let me tell you why I like ETFs. That it leverage and amplify the returns of underlying index, but it's a composite of a lot of indexes in one place. So I mean, think about it. If you leverage ETFs, you have like Pro Shares, Ultra Pro, S&P 500, UP Pro. You can have multiples of the returns of the index. Potentially, guess what happened to you? You could have more than 10% return. So you are diversifying your money literally. So in one basket, guess what you do in one basket? In one basket, you are able to have the most diversified, investments. Sometimes local and sometimes foreign, but they're all together. It's called exchange traded funds. So today, I recommend ETFs for a lot of your investing today. So you're not being controlled simply by one aspect of investments. Number 9, options trading. They say contracts that give the investor the right, but not the obligation, to buy or to sell an asset at a predetermined price, and that's the operating word. It's already predetermined. So if at this price, hold. If it's at this price, sell, but it's already predetermined. So what's the point here? Okay? While options trading can provide significant returns, with skilled traders potentially earning more than 10% in a short time. Example, call, and put options on individual stocks or indexes are a very good example of this. The risk though is this. It's highly speculative. And you know what I mean by speculative investments? Speculative investment means, you are in your highest risk of investing. So, option is very, very speculative. So you could win it all, you could lose it all. That's your options. But I want to talk about, is it giving you 10% return? Hell yeah. 10, 12, 13. But if you're willing to go that route, unfortunately, be willing to lose it also. Last but not least, high yield bonds, like your junk bonds. It's a bonds issued by companies. Simply, it's bond means I owe you. That's really what that means. So bonds issued by companies with lower credit ratings, offering higher yields and investment grade tools. We'll look at all of those as what we call your high yield bonds, also known as your junk bonds. You see, a lot of these bonds, just so you guys understand, you buy bonds, there's a duration to it. So you could buy a bond, it could be for 3 years, 4 years, or even 5 years. And maybe I give you 100,000, you promise you give me back 5% return. If it's a simple interest for this example, that simple interest could mean I get $5,000 on my 100,000. So bond means I owe you. That's what bond means. So basically, you're using my money to fund your company, and in return, you're giving me an interest rate back. That's your bonds. Okay. Why is it a good thing right now? Because you see, bonds issued by companies, typically, they give you an opportunity to be able to know, no matter what happens, your money is going to make money for you. Even if it was in a downturn, it doesn't matter. You got a promise, they got to keep the promise. Example is corporate bonds from companies like Ford or Occidental Petroleum. That's a very good example of this. The risk though is this. Increased risk of default, especially during economic recessions. And that's a risk that I don't think is only particular to this. I think it's the risk, that's particular to all and every one of them. So if you understood what I just went over with you guys now, this is how you can start making your money work for you and make it work for you like incredible. Let me go over one more time to recapitulate what I just went over with you guys. Number one is called the growth stocks. Number two is called REITs, real estate investment trust. Number three is called peer-to-peer, lending. And number four is called cryptocurrencies. Number five is your equity index life insurance policies. Number six, it's your private equity. 7 is venture capital. 8 is leveraged ETFs. 9 is options trading. And 10 is your high yield bonds. Those are the 10 different places right now where you can put your money and you can totally feel at peace. Let me wrap this up, okay? You see, guys, if I was to come on here right now and talk about the juicy news of the days, everybody's glued to it, crazy about it. If I say let's talk about the formula for money and fuel. If I say, guys, I'm going to give you the basic philosophy today on how to think clearly and make a bucket load of money, and all I want to do is pay this price, pay this, pay this, pay this. The crowd got even smaller. For whatever reason, when you're ready to make money, you're ready for everything. When you're not ready to make money, everything annoys you. And you annoy everybody. So it's a vice versa. You annoy people and people annoy you. I want to encourage you, put yourself in a place to make money and do it like really fast. Times are changing, things are changing. The people that make the money controls the world. And everybody else who is a beggar will remain in a position of begging. And a beggar doesn't have too much to offer, unfortunately, in an economy that is judging you by exactly the house you live in, the car you drive, the way you carry yourself, your clothing, your watch, your ring, if you know what I mean. So please take it very seriously to take investing as a high priority for you. So with that said, thank you for joining me today. Please walk like it's up to you and pray like it's up to God. Thanks, everybody.